Hello everyone, welcome to Timing Financial Markets Mentoring Program. Let me congratulate you on taking this step towards understanding and forecasting the markets with awesome accuracy. Let us work together and please put in sincere efforts to understand each and every concept shown in the program. You will not only be successfully forecasting the markets, but also trading them with methodical precision fairly quickly. At this stage, I would once again request you to not share the videos with anyone. You will appreciate it has taken me about 3.5 decades to synthesize the systems and endless hours at the computer to produce these videos. Yes, every part of these videos from content, script, animation, editing, voice has all been done and created by me personally. Please appreciate the enormous pains and efforts taken to produce this complete training program. It comes to you at a fraction of the fee I have charged institutions for the same knowledge and maybe even lesser content than this program. Piracy and theft of intellectual property is not only a crime, but is detrimental to our own growth. I personally know many people who have developed super successful programs and trading algorithms, but they do not share it or show anyone for fear of piracy and theft. In the end, piracy hurts not only the creator and author, but in a moral and tacit way, you're hurting yourself. When you begin to understand the astrology part of the program, you will also understand the law of cause and effect. We will begin to appreciate the universal forces that affect each and every one of us. Every immoral act has its effects, and any action on your part also brings you a similar effect. Be aware of the repercussions. The universe is unforgiving, and any action we undertake, either good or bad, is returned back to us multifold. Do not approach this program or the videos like a movie. The entire program has been planned and presented with a lot of effort and research. I started trading in June 1981, and at the time of making this presentation now, it's almost April 2021. It's nearing 40 years since my first trade. I've also been studying technical analysis for from 1988, almost 33 years to this day. During my journey of trading and studying the markets, I've had the opportunity to study almost every known theory and hundreds of systems and methods. There have been many systems I have discarded and many I even regret studying. However, in every system there is some element of merit. And this complete program is a culmination of those years of study and research. I have synthesized and taken points from many different systems and merged them into my own system. You will find many small ideas that you might have seen somewhere else. Do not disregard them as unimportant, as you will see. The application of some other system has been built on a primary understanding or method found in a completely unrelated thought process. There are numerous concepts that will be shown in detail while doing this program. Do not ignore a single concept. Prior understanding of the concept is essential to understand complex systems presented later on by combining and merging the basics. Please put an effort to understand each concept before moving ahead. I would like to share a secret at this time. Proper understanding and application of any subject for that matter depends hugely on your ability to recall the subject matter at will. However, the ability to recall at will improves vastly and manifold by using a very simple technique. Do not look at the videos for more than 15 minutes at a time. Completely understand the concept and stop thinking about the subject for 15 more minutes. Walk away from the computer, walk away from the video, put it off. In these 15 minutes, you should not think about what you have seen, but go about doing any other thing that interests you. Maybe read a book, listen to a movie, go for a walk, whatever. Come back again and watch the same section for 15 minutes later. Once again, walk away for another 15 minutes. Come back a third time and watch the same section again a third time. By this time, your brain has already processed the subject and it has already transferred it to the subconscious. The transfer from the conscious to the subconscious happens when you're not thinking about the subject. So this time, after the third viewing, check to see the concept on real market charts. You will no doubt find many instances of the concepts in the charts, and you'll also discover that this information has already been programmed into your subconscious, and this knowledge would have ingrained in your mind. Try this method and see how quickly you will remember and not forget anything that you have studied. You will also be able to recall almost everything that you have studied. If you still have difficulties recalling any of the concepts, then those are your difficult areas, as you have truly not understood the concept. In such cases, repeat the three-step process once again and you will very soon see results. So with that said, and without further ado, let's move ahead to the program. In this program, you will see many and varied concepts. I'm sure you have read many books and have a fairly good understanding of the charts and the markets and have been working with charts for a long time. One of the very first lessons of technical analysis almost always features the use of trend lines and how markets move in trends. Most students simply accept the fact and never wonder, where do these trend lines actually come from? Why do these lines appear to provide supports and resistances? Why do they work only a few times? And why do they fail at other times? When will a trend line provide support? And when will they fail? Elementary and pertinent questions. But most analysts or most students never even bother to ask the question. They don't even have an answer to the question. They have simply accepted the statement to be true and never dig deeper. By the end of this program, you will find an answer to almost every question you will have about the markets. Why do markets move swiftly sometimes? And why do they just keep meandering aimlessly some other time? When will any particular price action be seen? And when can we see a ferocious price movement? How far, how steep, and how long will a price movement be? Where do these strange trend lines appear from? Why does the market sometimes stop abruptly and unexpected points on the charts? And how to identify them weeks, months in advance. I will also point you to learn the basics of geometry, trigonometry, arithmetic, music, and various other things. I will also show you the basics. And if you are interested, you can definitely dig up and learn more. And most importantly, we'll be studying a lot of astrology and astronomy. Because without a basic knowledge of these, it is impossible to forecast specific points in price and time where you'll see a trend change. As you work through the program and even the very first session, this very session, I guarantee you will be amazed with the precision and movement, and there will be moments of awe. You will begin to wonder how you even miss these important and subtle points that have always been there in front of your eyes. The culmination of the whole program will be the application of astronomy and astrology, along with the other basics, and you will marvel at the perfect synchronization of all world events with the simple yet repeating events in the cosmos. Basic bar patterns. Let us begin by understanding the basics of charts. As you probably know, every price action of the market is reflected in that chart. The basic bar contains four elements of the price action in any time frame: the open price, the high price, the low price, and the closing price. This is elementary knowledge. Everyone knows about this. But what most people miss, the bars themselves, are exhibiting patterns. Just by looking at the bar here, we can see in this time period, prices opened at a low and prices were bid up and markets closed near the high price of the bar. The buyers dominated the market and bid up the price to take it higher, and this action continued till the end of the time period. This is a bullish bar within the bar itself. Now, look at this bar. Here, prices opened near the high of the time period, and by the end of that time period, prices declined and closed near the lows. The sellers dominated the market and continued selling lower, and this action continued till the end of the time period. This is a bearish pattern within the bar. Now look at this bar. In stark contrast to the earlier two patterns, you can immediately understand that in this time period, prices were volatile, and at some point in the time period, both the buyers and the sellers were active, and this action proved inconclusive, and prices closed back again near the opening price of the day. The pattern of the bar shows that the group is unsure about future market action, and this pattern shows uncertainty. There are many bar patterns and many more can be inferred by reflecting on these three basic patterns. In the next session, we will look at how we can distill more information from these three basic patterns. For now, understand that these three basic patterns and look at the historical charts till you're able to instinctively identify these three basic bar patterns. You may be wondering and thinking, you already know all this. Why is it so important to reflect on all of this? Understand, it is imperative to be very thorough with the basics and have a strong foundation to master the complex nature of the markets. Simple swing patterns. Earlier, you saw the pattern shown by the individual bar. When we combine bars, we can get more information. Look at this pattern here. Here, we see a series of bars with higher highs and higher lows on every consecutive bar. This is a simple upswing. A very important point to note, in a simple upswing, we are only concerned with the lows, and these lows should be higher on every bar. We do not pay attention to the highs. Institutions normally buy on the bid side of the market. It takes them days, weeks, and months to complete their acquisition. They put in a bid and let it fill up. The next day, they raise the bid price and let it fill up again. Thus, when you see a simple uptrend with higher lows on successive bars, you can infer there is a big buying program in action behind the scenes. Ultimately, it is the institutions that make the big shifts in the price action. Similarly, as prices decline, we should be watching the high prices on every successive bar. In a simple downtrend, we will see prices move lower on every successive bar, will post a lower high. The lows on the bars can be ignored in a simple downtrend. We only pay attention to the lower highs in a simple downtrend. Now look at this simple uptrend in a real market chart. You can see clearly how each successive bar has a higher low. Take a pause and try to find these simple uptrends and simple downtrends or simple upswings and simple downswings in real market charts. In simple swings or simple uptrends or simple downtrends, we treat the individual bars as a unit, and several of these units, meaning the individual bars, combine to form a simple uptrend. The simple uptrend and simple downtrend patterns can be seen in many time frames, but they assume the most importance on daily and weekly charts. Complex swing patterns. Individual bars join together to form a simple swing pattern, and these simple swing patterns join together to form a complex swing pattern. Look at this chart here. Here you see every simple uptrend followed by another simple downtrend, and that is once again followed by another simple upswing or an simple uptrend. The entire combination is a complex uptrend. Complex uptrends can also feature simple uptrends and complex downtrends, or complex uptrends and simple downtrends. Just like the simple trends, complex uptrends and complex downtrends are composed of many simple trends alternating. The simple trends are individual units of the complex trend. Look at this chart here. In the simple uptrend, we observe every successive unit or every successive bar to have higher bottom. And in a simple downtrend, we observe every successive bar to have lower highs. In the case of the complex uptrend, we can see that the individual units, meaning the simple downtrends or the simple uptrends, exhibit a series of higher bottoms and higher tops. When the chart is unfolding a simple uptrend, we pay attention only to the bottoms. Note, we are only paying attention to the swing lows in a complex uptrend. We do not pay attention to the highs. While it may or may not make a higher top, but the bottom in the complex uptrend has to be higher. Keep watching as markets unfold. If they are making a series of higher bottoms, you can instantly assume that the market is in an uptrend. In the case of the complex downtrend, we see a series of lower highs and we do not pay attention to the lows. While you hear the expression market is showing higher lows and higher bottoms or lower tops and lower bottoms, we now know what exactly to pay attention to. In the downswing, complex downswing or the complex downtrend, we don't pay attention to the bottom, we only pay attention to the lower tops that are being posted. This simple differentiation of observing the lows in an uptrend or upswing and the highs, lower highs in a downtrend or a downswing will instantly tell you where the markets are heading next. See this chart here and see this simple complex downswing. This downswing is made up of a simple downtrend and a complex uptrend, simple downtrend again followed by complex uptrend, and you can clearly see that it is a very complex uptrend and every successive high is lower. Primary use of trend patterns. We have been learning the patterns. We have looked at the simple patterns, the simple upswing, the simple downswing, the complex uptrend and the complex downtrend, and we have seen so far that the simple upswing has every successive bar posting a higher bottom, and the simple downswing has every successive bar posting a lower high, and the complex upswing has posts higher lows, and the complex downswing posts lower highs. But why are we paying attention to this at this point? I will illustrate. Let's see why is it so important and what difference it actually makes to our trading. Most traders hear the statement, but they realize its value. Here's the statement that the market is posting high tops, high bottom, market is in a downtrend or a trend, but they rarely realize its value and have no clue on how to read the chart. Market is making a pattern of higher highs and higher lows. We now know what it means when the market is in an uptrend and the most suitable action to be taken is to buy on dips. Thus, when the market is showing a series of higher lows, let me explain. Before that, we need to understand that all trends are basically patterns. This is the same pattern that is being repeated again and again by the market. When a market is posting uptrends, which means higher tops and higher bottoms, as is generally heard. But as we now know, we are looking only at the bottoms, so we are looking for higher bottoms. When a market is showing a series of higher bottoms, we wait to buy at a dip above the most recent low. And if the market is making a series of lower highs, we sell or go short on every rally lower than the most previous high. Thus, we know if we have to buy or go short, or if we have to buy or sell based on the patterns on the chart, and the charts are constantly screaming about the action to take. We simply need to understand this language of the markets. There exists another more powerful method of knowing the action to be taken based on an understanding of elite wave patterns. We shall learn about them when we learn the basics and how to break down the patterns of elite, which will come in a later session. Thus, we can distill our understanding to just 2 points. If bullish, meaning we see a simple upswing or a complex uptrend or on a complex upswing, we wait to buy at a dip above the most recent low. And if we find the market going down, meaning a complex downtrend or a simple downtrend or a simple downswing, we sell or go short on each rally high lower than the previous high. Many of you have asked the question after watching the Timing Financial Markets video, sir, how do we know whether we need to buy or we need to sell? And I was continuously surprised why everyone was asking this question until it dawned on me that most traders are really not paying attention to what the trend of the market is. If you understand the trend of the market and the timing date falls on one of the dates and you see the market is making a lower high, you instantly know what action to be taken. The reversal bar signal pattern. We have seen this in the Timing Financial Markets video, but we'll dig a little deeper and try to understand a little more about the reversal bars and the reversal swings. As you have seen in the Timing Financial Markets video course and also in the simple swing, every swing will have one bar at the end where the low of the high bar is broken on the subsequent bar. This combination is the reversal swing pattern. In an upswing, the low of the high bar is broken to the downside on the next bar. However, remember this very important point here. Many times with the swing, we see the low of the high bar broken only temporarily for one bar and subsequently resumes the uptrend. It could be followed by many bars than just one bar, but the low of the previous bar is not broken. A change in a simple swing trend is only confirmed when the low of the previous two bars is broken. This would be called a perfect confirmed swing reversal when the low of the second bar is also broken. Now, the most important rule for the market always is markets can break one but rarely break two. So this was the last bar, so it can break the low of this bar. Sure, if you want to trade, we do take an entry here and put in a stop loss, but to actually have a confirmed reversal of signal, we need to break two bars, the bottoms of the last two bars. Similarly, in a downtrend, the high of the low bar is broken to the upside on the next bar. Now, as you have already observed, since this is an upswing, we are paying attention to the lows. And since this is a downswing, we are only paying attention to the highs. Only to qualify the last bar, we see the last bar with the lowest low. The bar with the lowest low. The high of the last bar with the lowest low is broken. We can say the trend is broken. But as I said before, the low or the high of the last bar can be broken by 1 or 2 bars. Without breaking the second bar or the second high of the second bar, we can continue in the direction. So the break and change in trend or the break of trend is only confirmed when we have the high of 2 bars being broken in a downswing. Once again, I repeat, markets can break 1 but rarely break 2. See the reversal bar signal pattern on this real market chart. You will see this pattern on simple swing every time markets change their trend. Many times you will see a large elongated bar that has a range multiple of the usual market action. In such cases, most traders expect the market to reverse the very next day. Especially in the case of a bullish bar or a bearish bar, markets appear to dip, rally the next day and resume the earlier trend. It is unlikely to see a reversal in trend after an elongated bar. Why? To actually get a reversal, you will need to break the low of the elongated bullish bar or break the high of the elongated bearish bar. So it would be unreasonable to expect a large action immediately the next day. Sure, it does happen sometimes. But if you observe or study the charts, you will see that after a elongated bar, markets generally continue in their direction for at least 2 or 3 time periods. That would be the minimum, and before the trend actually changes and you see a reversal bar. Study this in the charts and you will see there are many times when the traders are expecting the market to reverse after a elongated bar. You can actually buy a dip the very next day. We will talk about how to buy the dips on individual bars in a later session, but at the moment just observe this pattern. See this same action on a real market chart. The elongated bar almost always points to more bars ahead in the same direction with narrow ranges before any trend change can be seen. Reversal of trend. In a simple swing, a reversal is seen when the basic unit, which is the bar itself, is broken. A confirmation is assumed only when 2 bars are broken. In a simple swing, the basic unit of the swing is a bar, and in a complex swing, the basic unit is the simple swing. Thus, in an uptrend or a complex upswing, till the low of the last simple swing is not broken, it would be wrong to assume the larger trend has changed. The same rule of breaking 2 applies here. Markets can break one swing and resume its earlier trend, but again cannot break 2 swings or cannot break 2 swing lows or 2 swing highs and not change the trend. So to point out, whenever markets break one swing, it is entirely possible that the market will resume its trend before breaking the second swing low. However, if this in a complex uptrend, if 2 prior swing lows are broken, then you will see that the market trend has indeed changed. See how only one swing high is broken here and then the downtrend resumes. Here is one swing. This swing was broken when the market went up. However, 2 swings back, it did not break it. It tested this point again and started down. So you should study this phenomenon on many real charts to truly understand this concept before moving ahead. Understand this carefully. The basic rule of the market. Market can break one but not 2. It could be the bar itself or it could be the swing highs in a downtrend or swing lows in an uptrend. Reversal bar breakpoint retest. It's a very interesting phenomenon. Let's see what this is. Markets almost always show this interesting pattern. In a simple upswing, you will see the break point or the breakdown point, that is the low of the high bar, being retested at least once after the breakout on subsequent bars. This behavior can be seen invariably. Here's the breakdown point. This breakdown point was broken, and as you see on this green bar, almost immediately this breakpoint was retested and then the market headed lower. Now let's look at this in a real market chart. See in this real market chart how the simple swing breakpoint is retested almost immediately. And at this point, markets threaten to change their trend only to retest the breakdown point and start the downside movement yet again. And once again, the same behavior of retesting the breakpoint is seen and markets move up. Whenever markets are making lows or highs, it becomes extremely rewarding to watch out for previous swing break points and observe if it is a retest of the previous swing break level. Invariably, when it is also a timing date or time period, you will have a rewarding trade. I normally pay a lot of attention to previous swing breakpoint highs and lows. Now all this brings us to very important and essential understandings of the chart. We have seen how the trends reverse and that it is essential to break two bars or two swings to change the trend of the market. We now also know that a trend is a series of higher highs and higher lows or lower highs and lower lows. In the next step, we need to combine both these observations to arrive at a very important understanding of the markets. That is, to change the trend, we should see the horizontal levels posted by the swing highs and the swing lows, which is a lower high in a declining trend or higher lows in a uptrend to be broken, and at the same time also observe a pattern of higher highs and higher lows on the opposite side. Please understand this statement completely, as this observation alone will keep you safe from assuming that the trend has changed erroneously and prematurely. To repeat, to change the trend, it is essential to break the horizontal support and resistances given by the earlier trend and also have a pattern of lower highs, lower lows or higher highs, higher lows depending on the direction of the changed trend. Look at this chart here and see how at the final bottom there are a series of swing highs in a declining market, and they are broken by the changed trend of higher highs and more importantly higher lows. The trend here has truly changed. Now please stop and apply all that you have learned on real market charts and study real market charts. Understand the concept thoroughly and come back to the next topic. Please move to the next topic only with a fresh and calm mind, as it is a very important, very powerful and hidden observation of the market, and you want to know and study it in depth. See you after you see the real market charts. Bar genetics. Every price bar posted on the charts has hidden information, and it is intrinsically connected to every other bar on the chart. W.D. Gann said, "If you know the beginning, you know the end." If you understand basic music theory, you will be able to understand this concept better. For those who are interested in learning more and digging deeper, I suggest you study the diatonic music scale and the theory of octaves. Once again, this comes from the ancient Greek philosopher and thinker Pythagoras. W.D. Gann was a great student of the Pythagorean theories. Let us see one interesting phenomena that we rarely observe on the markets. We will be studying much deeper about this in later sessions, but for this session, let's look at the octaves. Basic music theory says that when you double the number of vibrations, you will hear the same tone. Thus, a tone at 64 vibrations per second will sound similar to a tone at 128 vibrations. And even when it is doubled again, it will sound similar at 256 vibrations a second. You will also appreciate computer memory is calculated in a similar fashion. 128 megabits, 64 gigabits, which is basically doubling from 1 to 2 to 4 to 8 to 16 to 20, 32 to 64 to 128. Why do these numbers repeat again and again in our life? We will look at more on this in future sessions, but for now, we shall look at the doubling phenomena, or what is called in music a higher octave. We take the range of the very first bar, that is the bar with the highest high or the lowest low. The range of this bar is calculated by subtracting the low from the high, and we get the total range of that particular bar. Now, if the market is in an uptrend, we add the value from the range once to the high. In effect, we are doubling the range of the bar. This is the range of the bar multiplied by 2. We will see the market take resistance around that level. Next, we double the range again and add it to the new calculated high. This is in effect multiplying the range by 4. We will see the market take resistance yet again around this point. Next, we can double the range once again and add it to the new calculated high. This is in effect multiplying the range by 8. We will see the market take resistance yet again at this new level. As long as the market keeps moving higher, we can continue this process and markets will be seen to post the final high only around an octave of this range. Note this point, market will be seen to post the final high only around an octave of this range. There are many other levels you can calculate by a deeper understanding of the diatonic scale, and we will look at it in future sessions. This is the basic lesson on application of the music theory to the markets. Now look at this chart here. The range of the bar posting the highest high is 96.95. We then multiply it by 2, by 4 and 8 and subtract those values from the low of the bar because the market is in a downtrend. In effect, we are doubling the range, doubling it again and doubling it for a third time. Now see how market found support at the first doubling of the range. When we double it again, it finds support. And yet again, when we double it third time, it finds support again, once again. Another important point that you should note here is after each doubling of the range, the market swings are of a greater magnitude than before. Understand this entire phenomena, and if required, please watch the last two sections again and understand that the very first bar of the swing, which is the bar with the highest high or the lowest low, always has this genetics hidden within it. Today, in this session, we are only looking at the price behavior or the information we derive about the price. Later, we will look at the information we derive about time, and we will then look at the information about price and time combined. Now please hit pause and study this phenomena on many real market charts till you are thorough with the concept. Understanding this concept is imperative to be successful in trading the markets. Do not move ahead till you study and apply this again and again on charts by yourselves. You will begin to see the charts in a different light and markets will begin to whisper their language to you. I will see you in the next session on astrology. Now please check a number of charts and Digest this knowledge before you move ahead. We now have come to the astrology part of the session. I will be introducing small bits and lessons in every session over the next few months, and by the end of these 4 to 5, 6, 8 months, I will take you to understand every part of astrology right from the basics. So you may know some of the things that are shared today, but please understand, and we will build up on the knowledge bit by bit so that we can understand the complex parts later. Now, we all study the basics of the planetary system in school. We learn that the sun is the center of the universe and Earth rotates around it and all. But watching the skies with fascination was one of the favorite pastimes of the ancients before they began to understand the effects of the cosmos on events on the world. Let us understand from a very basic and chronological manner to appreciate and truly master how the ancients actually used the cosmos to foretell events in the world to precision. Most of the events and their effects have been coded in the form of mythology, religious icons, and religious books, and we only need to be open to the idea to understand the depth of their thoughts and use their observations in the modern day to our benefit. As we all know, the sun is the center of the solar system, and all planets revolve around the sun. In the order moving away from the sun, the planets are Mercury, Venus, Earth, Mars, Jupiter, Saturn, Uranus, Neptune, and Pluto. The ancients also added moon, as the moon was the closest and the most visible, very bright heavenly body in the night sky, and many times you can also see the moon in the daylight. Thus, they observed the moon, sun, Mercury, Venus, Earth, Jupiter, and Saturn. 7 planets in all. Planets beyond Saturn are invisible to the naked eye. We would need very powerful telescopes to see the planets beyond Saturn. We will look at the cycles and points from where we observe the sky in a later session. For now, there's one basic important point that you need to understand here. Please understand, as planets that are farther and farther away from the sun have a slower and slower speed around the sun. This is especially important to understand when it comes to breaking down the cycles and understanding the cycles within the cycles. So at this time, note one major important point. A planet nearer the sun, meaning Mercury, or the Mercury is nearest to the sun, it moves the fastest, and Saturn, which is the slowest, takes about 30 years to complete one cycle around the sun. Now with that said, let's move ahead and look at everything from the very basic point of the Earth as how the ancients looked. Let us now look at the very basic unit, the Earth itself. Earth rotates around its own axis every day. The axis is an imaginary line drawn connecting the top to the bottom of Earth. We will look at why the day was broken to 24 hours later, but for now, Earth rotates around itself every day. Truly speaking, it's one day and one night, but for now, a term of a day will suffice to understand. Now this axis, or the vertical line around which Earth rotates, is not vertical. It is inclined at an angle of 23.6 degrees away from the vertical. It can also be said to be inclined 66.4 degrees inclined away from the horizontal. Remember these angles, 23.6 degrees and 66.4 degrees. They will come to haunt us later. Now, the axis which is not vertical creates a very interesting point for on how we observe the movement of the sun. We will come to this a little later. But before that, we need to understand that the ancients drew a line in the middle of the earth. It was an imaginary line. The equator, or one which equates or makes equal, is an imaginary line drawn around the middle of the earth, dividing the earth into two half spheres or two hemispheres, the north and the south. Observe how the equator is also inclined at an angle of 23.6 degrees. Earth also revolves around the sun, completing one full circle in 365.25 days. We all know about it. We call this a year. When we plot the revolution of the earth around the sun, we see it is not a true circle but an ellipse. The sun is at one focal point of the ellipse and the other point is an empty space. Study the construction of the ellipse if you need more details. Just as the planets further from the sun move slower, there is a strange behavior which all the planets do, or planets show. Whenever they are closer to the sun, because every planet has an elliptical orbit and it is not a perfect circle. Whenever they are closest to the sun, they move faster, and whenever they are farther away from the sun, they move slower. During the months of January and February, Earth is closer to sun, and that is why we have 28 days in February. And when the Earth is farthest away from the sun, which is in July and August, we have the longest days, and the speed is slower, hence we have 31 days in both July and August. There is a method in the madness. When the planet is near the sun, it is said to be in perihelion, and when it is farther away from the sun, it is said to be in aphelion. Remember these two terms because we will be using them extensively. Perihelion means nearer the sun and faster movement, and aphelion means farther away from the sun and slower movement. The ratio between the largest width of the, or also called the major axis of the ellipse, to the short width, also called the minor axis of the ellipse, is very close to the Fibonacci ratio. You may have heard of the Fibonacci ratio, and we will study Fibonacci and its true applications in a later session. But for now, it suffices to understand the ratio between the two. Just for understanding, a circle is also an ellipse where the major and the minor axes are equal. Observe and appreciate that the Earth moves faster when it is in perihelion, which is closest to the sun, and these faster movements happen during the month of January and February, which is why we have 28 days in February. And the slower movement happens in the months of July and August, which is why we have 2 months of July and August having 31 days each. Now, as Earth revolves around the sun and due to the incline of the axis, on 22nd of December, it reaches a point in the universe from which the sun appears to be at the lowest point on the horizon. Sun appears to be 23.6 degrees below the equator. Now, as Earth revolves around the sun, it reaches the exact point opposite, and at this point, the sun appears to be 23.6 degrees above the equator. The sun does not truly move. It is an apparent visual phenomena seen because of the incline of Earth's axis. Similarly, on 2 other dates, which is between these 2 dates of 22nd December and 21st of March, about 22nd of June, the 2 dates are the 21st of March and 22nd of September. Sun appears to be exactly on the equator. These 4 points divide the ellipse into 4 equal parts. Measured with the sun as a center point, the angle between each of these points is 90 degrees. As these 4 points are of the greatest importance and mark very important changes in nature, the ancients tried to convey the meaning with mythology, religious icons, and symbolisms. The minute I put in the symbolisms, you will understand what they were trying to say, and it will begin to make a lot of sense. You may have understand this looks like a spiral. The staff of Hippocrates is exactly what it is, and this is also called the wisdom of Isis or the wisdom of the serpent. The Hindu swastika, they all essentially point to the same thing, the 4 points in the universe from where the sun appears to go up and down. And the Christian cross, all are symbolisms conveying the importance of these 4 points in the universe. We will study all this in great detail in future sessions. For now, understand these 4 dates in the calendar which are very important. The 22nd of December, when the sun appears to be at the lowest point, the 21st of March or 2nd of June, when sun appears to be at the highest point, the 21st of March, and the 22nd of September. We will see this in the next slide once again. Now, as Earth revolves around the sun, the plane of the equator was extended into the cosmos everywhere, and this plane was called the celestial equator. It is nothing but the equator extended horizontally into space. As sun does not appear to go above 23.6 degrees, another imaginary circle was drawn at 23.6 degrees above the celestial equator with Earth as the center. And similarly, as the sun does not appear to go below 23.6 degrees below the equator, another line was drawn at 23.6 degrees south of the equator with Earth as the center point. The band 23.6 degrees above the equator and 23.6 degrees below the equator is called the ecliptic. There are millions and millions of stars and constellations in the universe. However, because of this imaginary boundary of 23.6 degrees on both sides of the equator, the ancients paid a lot of attention to the patterns of the stars between these two lines. And they divided the band into 12 equal parts or 12 equal arcs. Why only 12? We will study all that later. They observed some patterns of animals in these stars and started naming them. They named the constellation as Aries the ram, Taurus the bull, Gemini the twins, Cancer the crab, Leo the lion, Virgo the virgin, Libra the balance, Scorpio the scorpion, Sagittarius the horse, Capricorn the goat, Aquarius the water bearer, and Pisces the fish. To this day, because the ancients saw the patterns of animals in the sky, we call this the zodiac, coming from the word, and coming from the word zoology and zoo. It is a literal jungle out there with animals and strange beings out in the skies. Now you will appreciate that when you go out and see in the sky, there are many constellations. I do not know if you have actually gone out into the night sky and observed the starry sky. But apart from these 12 constellations, there are millions and billions of constellations all around. But the ancients paid attention only to this because this is the band, this 46, 47 degrees is the band in which the sun, or which is the actual movement of the sun, and the sun appears to move like a sine wave in this, which looks like a snake intertwined or around this continuous circle. You may have seen the snake represented as a circle eating its own tail, which is nothing but the entire movement of the sun in the horizon. Now this band of the ecliptic and the movement of the earth around the sun creates an illusion because we observe from earth that the sun keeps going up and down. Now the sun appears to cross as we have seen earlier, from the sun appears on the equator on the 21st of March and starts to move higher and higher from the equator every day after that. Thus, on 21st of March, Earth is actually situated in front of the constellation Libra. And as we see the sun on the 21st of March from the point of the constellation Libra, we see the sun in the we see the constellation Aries behind sun, which is why we say the sun rises in Aries on 21st of March. Now, on the 21st of March, the sun appears to be right in the middle of constellation Aries, and there begins the movement of Earth. Thus, after March 21st was assumed to be the beginning of the year, on this day, Earth is situated here on the constellation Libra. Now, 3 months, as it starts moving, 3 months later, the constellation behind the sun appears to be Cancer. That is 21st of 22nd of June. And when the sun, Earth, is in Capricorn and Cancer is seen beyond, the sun is at the highest point of 23.6 degrees, which is why the upper line was called the Tropic of Cancer. When Earth comes to the point of Aries, we see Libra behind sun, and when Earth comes to the Tropic of Cancer, we see the Tropic of Capricorn, the constellation Capricorn behind sun. And at this point, sun appears to be at the lowest point of 23.6 degrees. Hence, the imaginary line, which is shown here in blue, is called the Tropic of Capricorn. So these two lines, which we hear about in geography, are nothing but the limits of the sun's apparent movement above and below the equator. These 4 points and these 4 dates are very important times, as you will see later. Please study and understand this movement of the sun, apparent movement of the sun, the movement of Earth, the movement of the sun north and south of equator, and the 4 special dates, which is 21st of March, 22nd of June, 22nd of September, and 22nd of December. Carefully and understand the circular movement and also the up and down movement of the sun. I will see you again in the next session.